Welcome to KTN Business. Let's start with some good news. And you'll soon be able to take loans from your local banks at a much lower interest rate thanks to the listing of the $2 billion Eurobond. With the government getting 4 times its intended tax treasury plans to exit the domestic borrowing market, a move that is likely to spur private sector lending. Just how will Eurobond inspire a reduction in lending rates? Late Changole reports.
3 months ago, the government announced plans to reduce reliance on domestic sources of funds as it sought to push commercial lending rates to less than 10% within the next year. And yesterday, the government announced the successful listing the $2 billion Eurobond.
We had 340 million in the targeted budget deficit. So it was extremely important that we actually got Eurobond right. That was up about half of that budget deficit.
The debut bond was oversubscribed by 500%, attracting bids of $8.8 billion against a target of $1.5 billion. The country actually accepted $2 billion a premium. The government had said see domestic borrowing fall below the targeted 199.8 billion shillings in the 2014-2015 financial year.
We will reduce government borrowing from the domestic markets, thereby helping drive down interest rates.
As the biggest borrower with a low credit rating, government invariably crowds out the private sector whenever it borrows from the local market. As such, when the government introduces demand for local funds, banks will be left idle monies, which will translate to lower interest rates as banks target private sector players who will finally get access to much needed credit needed to grow their businesses.
By government actually being not too aggressive in the domestic market, it helps banks to focus more on the individual and local business, which has a tendency of reducing rates.
But even as the state admits that it will be reducing borrowing, it says it cannot specify magnitude just yet.
In terms of the magnitude, at this point, we cannot say how much, but certainly it will be reviewed downwards.
Even then, the 190.88 billion shillings that was to be raised for the local market this year was a whopping 78 billion shillings more. The 106.8 billion shillings raised in the 2013-2014 financial year and a record in Kenya's history. So even with the reduction, and experts say the government still needs to exercise more caution, especially if it hopes to see lending rates hitting 10% in the near term.
Government has to get its finances right. It needs to focus more on raising its revenues as well, so that it doesn't borrow domestically as much.
KTN Business.